Good afternoon, everyone. My name is Khalid Al-Musa. I'm the CMO for the Memorial Hermann Katie and Cypress campuses. Welcome. This is the second in a three-part series of personal finance education that is provided to our physicians, courtesy of the wellness committees at both these campuses. The first first talk happened last month, and as Enpo alluded to, it was sent out via link for those who cannot attend it in person, even those who could. It's available as well, and we will do the same for this in the next series. The next talk will be later in September. The group, the team that we are working with and collaborative working with is My Financial Coach, an organization that we've learned about through the American Association of Physician Leadership. This is an organization that works with physicians along the country, all throughout the country, and helps with personal financial education and coaching. We will have a presentation here shortly, and then leave some time for some question and answers towards the end. The disclaimer, just to be sure everyone's aware, this is an educational session only. This is not providing any investment advice, legal advice, or any tax advice, and there's no link to Memorial Hermann per se. It's just that our physician groups welcome this resource for our physicians. If you choose to connect with My Financial Coach, you can certainly do so, but that'll be totally on your own after and on your own dime and cost and anything like that, should you wish to do that. This is again purely for educational purposes. A personal disclosure, I'm a client of My Financial Coach, as I learned through them through AAPL. I receive no benefits, no credit, no money, no kickback, no discount, nothing of anything that by bringing this to you all, and the same for Memorial Hermann or our wellness committees. We are paying My Financial Coach for these series just like they do for any other clients. We will ask for your feedback at the end of this. Again, this is a service to our physicians. If there's any benefit, if there's any ways we can improve on this, we'd like to know. A survey will go out together with a link next week. So without further ado, I will introduce Enpo Tu. Enpo is the Chief Operating Officer for My Financial Coach Education organization, and he will just share a little bit about his background and then also proceed with a talk. Enpo, welcome and thank you.
Well, thank you very much, Dr. Khalid, and thank you everyone for taking a little bit of time out of your day to learn the basics of finances, personal in nature. Just a little bit of my background. I am a certified financial planner, as well as holding my Master's of Science in Financial Services, lots of other designations and credentials that give me kind of an educational background in financial services. I will say that probably the biggest thing that I've been very fortunate to have is the opportunity to work with hundreds of physician and medical related families over the years, from those that are just building wealth, oftentimes lots of student loans, lots of competing interests, all the way to the C-suites, whether it is medical in nature, credit unions, etc. And I've seen a lot of different opportunities for improvement. Because what I have found is, more often than not, people are trying to figure out what to do with their personal wealth. And we've noted a number of inefficiencies that it doesn't really matter if you've been, I suppose, making more and more money income wise, or building more and more wealth through your retirement plans, maybe investment properties. We oftentimes still find gaps in knowledge. And today, what I'd like to do is to help you uncover some of those gaps that we see that are just kind of very common, just because the frame of reference for how you make financial decisions is sometimes obscured by what I call the story of why you're doing something versus the math and science of why you should be doing something. And we want to be as logical as possible while still understanding that personal finances are very personal in nature, where if you do the math and science wrong, it will have often immediate impacts on you, but also impacts that you're not going to be able to see or feel until many decades later. And you can certainly use math to try to figure out what that will look like. Uh, but it is a little hard to understand. So this is actually a preview of the webinar that I will be giving for the American Association of Physician Leadership on this very same topic, because it's a very common trend. Doesn't matter if you've just started or if you've been doing financial things for many years. This is still something that I would say that anyone can improve on. So really today, want to improve everyone's financial literacy, try to understand, hey, how is it that we can come up with solid frameworks to understand how to address certain financial topics in a way that you can't just chat GPT it or whatnot, because you're not even quite sure what the question ought to be. And when it comes to that, creating that professional style framework, I'm going to give you a glimpse into how I think and how I help my clients problem solve. Because a lot of the times, it's not that I'm coming up with ideas that are completely unheard of or brand new. I just help to reframe and recontextualize some of the decisions that a lot of my clients make on a day-to-day basis. And then I really want to hammer home that there's a lot of pseudoscience out there about what is good financial planning. And some of the things you'll hear a lot is, well, I do this to save taxes, or I do this to build wealth. And what I'd like to do is really to zero in and unveil some of the things that I would consider to be pseudoscience and just give you a solid example. So that way you can have more conversations that are tailored to you and you personally. So oftentimes I will use this as a conversation piece when I first start working with clients. And this question is, what is the greatest asset for a physician? And, for those who are just starting their financial literacy journey, oftentimes they'll say things like, oh, I guess my home or my retirement plans, or, they'll say things along the lines of, well, my family, um, home that I've put a lot of effort into. For those that have maybe read on some forums or tried to improve their financial literacy, they may say something like, "Well, my ability to earn an income, or some of my passive income streams that I plan to build." And what's interesting is the answer is often tied to where they are on their financial literacy journey. But what I have found is there's really only one right answer, in my humble opinion, for the vast majority of the clients we work with. And the answer is it changes over time. When you first begin your financial journey, unless you are already independently wealthy and you are just a physician as a hobby, as opposed to as a money making source of effort, I suppose. If this is just a hobby for you, then this will not really apply to you. But if you are using your physician career to try to build wealth for yourself, then often it will be in this order what your greatest asset is at any given time. And I would say initially, it's your ability to produce income. So thinking about what that means, the easiest thing is, well, you put in a lot of effort to go through undergrad, medical school. Many of you maybe are in your fellowship, or maybe you just passed your fellowship, and or just taking a look at just beginning medicine, just starting to really earn. But later on, there's other things you can do, such as going to specialties or go into areas of medicine that are more lucrative than what you're currently in. Uh, I've often found that income production, the ability to earn as much income as possible, that's your greatest asset initially. Now, through a number of years, you're going to make that income, and you're going to make that income work for you. You're going to start buying things such as assets inside of retirement accounts. You're then maybe going to start looking at other ways to leverage that income. Many of you may have heard of a great marketing term. It's called physician loans, or for us common people, they're called zero down mortgages. because the marketing department works miracles. And what you're going to find is for these 0% down mortgages, you're going to get an asset, which is a home. And over time, as you pay down that loan, you're going to end up owning that asset and hopefully it'll appreciate over time as well. And as you keep buying these assets, eventually they will probably be your greatest source of wealth as you continue potentially down that path by rental properties, etc. Because what will end up happening is eventually that wealth that you've built is actually greater than your annual income. And you will find that inflection point at some point. And finally, if you've done a good enough job of paying down your assets, what you're going to find is you're going to slowly, and through the help of sometimes your employer, you're going to be able to build up significant retirement accounts. And these are what I call your income created assets. And there's a lot of things that you've done, such as pay down that mortgage for your primary home. Maybe you've bought some properties outside of your primary residence as well. All of that is done using your income. So I think really, probably, people are right that your income is your greatest asset. So let's talk about your income, because I have found that a lot of you and your colleagues in the medical field talk income. How much do you make? I want to know how much I make versus someone else. Why is it that that's such an important item? Why is passive income so important? Well, I think it's because it comes from the fact that a lot of this ability to build wealth rests on that bedrock. And that is the initial touch point. You're initially very income focused because that's the thing that helps you accomplish a lot of the other things that you're trying to do. So I have an example for everyone here, and I'll use physician 1, 2, 3, and 4. They get together, they're at a conference, they're hanging out with each other, they're learning all about medicine and all the cool things, and then they start talking brass tacks. They go, hey, I work at Memorial Hermann. Oh, I work at Kaiser. I work at, and what they're going to do is they're going to start comparing their incomes. And so the first person says, hey, actually, and they're not going to say this, all of them are going to say, I make $500,000. All right, great. That's amazing. Everyone here is on an equal footing. Everyone is making $500,000. Now, oftentimes you and your colleagues are not talking about how that income is calculated and how that income actually affects your wealth building potentials. Because going back to what I was saying earlier, a lot of what you're trying to do is built on that income. So let's talk physician 1. 200,000 W-2 salary. And then if you look through your contract, you're going to find a few details like negotiated pay, bonus pay, but all of this is W-2 income. Okay. Physician 2, very straightforward, all W-2 income. Physician 3, enterprising individual, says, hey, actually, quarter of a million is my W-2 role, but I also had the ability to get some 1099 income as well through the employer, and I'm able to do a few interesting things with that. But all in all, everyone just says, well, this is how much I make in total. So physician 4, actually, it's all 1099 income. All right. So let's reframe everything using math and science as opposed to just call it the headline pseudoscience vibes of language. So what people are instantly going to realize really quickly are once they start earning income. And by the way, all 4 of these individuals single. So that's their first mistake. If you're single, the IRS doesn't like that very much. And they're going to tax you at single taxpayer rates, some of the highest rates possible. So once they get their paychecks, there's going to be a few things taken out of it, because we all know that if you make, let's say, $1,000 of income, you're not seeing $1,000 in your bank account. That's not happening. Of course, there are things that you pay for, such as health insurance, but there are things that you're asked to pay for, such as federal income tax, potentially state income tax, although in this example, there is no state and local, Social Security, Medicare, and potentially, depending on what states everyone moves around to, there's some state disability, etc. In this example, none of those, but you definitely have federal income, Social Security, and Medicare, no matter what. And so this is the example I use. So our two W-2 physicians, in this case, their annual take home is 339,000. Let's just say 340. All right. So actually that feels good. Now for the 1099 individual, wow, that's 318. Doesn't feel very good. Why is it? Well, when you're on 1099 income, you have to pay both sides of the employment tax. But that being said, when you're working for a W-2 employer, they will pay their portion. Now, it is true that you get to deduct when you're earning 1099 income, whatever you pay, but you're still having to pay it. So net, you still have less money right now in this scenario as a 1099. So you're thinking, wow, W-2 must be the best thing ever. Well, hey, that's just math and science level 1. Let's go into math and science level 2 on income. So nothing is in a vacuum. Everything plays on top of itself. So for physician 1 and physician 2, because they are earning this W-2 income, their employer is oftentimes also giving them group benefits. Now, remember earlier how I said that physician 1 actually had a very interesting pay structure where it's not all necessarily base pay. Some of it is bonus pay, some of it's negotiated pay. What does all that mean, and why is that maybe a good or bad thing? Well, here's what's interesting. Hospitals, from what I've been told, sometimes like to save costs in little ways, and sometimes it adds up. These big organizations, if they can just save a little bit of money, it actually helps to make operations a lot smoother. And one of the ways that they can do that is by structuring the contract such that there are certain benefits that are tied to your base salary. And if it is tied to your base salary, then what's going to end up happening is once you look at what benefits are actually being paid for, you need to look very closely. And this is not a knock against your employer. Oftentimes, there are ways to fix these things. But when a lot of employees do not value some of these benefits that are being paid, it does make sense to lower the benefit of it for those that don't really value it, while still giving opportunities for those that do to make up the difference. But if you're not looking at your contract and what group benefits are tied to your base salary and how that's calculated, when you actually need to claim that benefit, you could be shocked. There is, and I'm not going to name any names, I had a client who worked for a very well-known educational uh, research university. And when I looked at their benefits, their base disability insurance was tied to their salary. And their negotiated pay and all the other negotiated bonus was very high, but their base salary was actually very low. And so when I evaluated that group disability, it would not have covered even a tenth of their income based on the base amount that was paid to the individual based on that group policy, based on how the benefit is calculated. So I also want to note that sometimes when you look at that contract and it's tied to RVUs, bonus pay, etc., sometimes there are variations in that payment. They're projecting that you will make about 500,000, but it is also possible, based on how the contract is written, that it might not be 500,000 just because of how the compensation is calculated. So everyone's looking at Physician 2 right now and going, wow, that's great. Great benefits, benefits tied to salary, so 100% consistent. That's actually great. Physician 1's getting less, Physician 2's getting more. Oh, that's great. So we go to Physician 3. Interesting. They got the group benefits. That's amazing from the W-2. But hey, now I got $250,000 of 1099 income, and I'm thinking to myself, well, let me try to save on some taxes then. Since 1099 income, as many of you may or may not know, you can structure it in a way where you could perhaps mitigate some taxes and write some things off. Well, in order to do that, unless you want to learn how to use QuickBooks and really keep receipts, you might end up needing to hire a bookkeeper as well as a CPA. And potentially a lot of 1099 income is tied to some sort of performance metric. That is what I've seen a lot of. And so there may be some variations in your pay. All right, let's talk about Physician 4. Man, this guy is not doing super hot because, as you can see, the group benefits, they don't have any. They have to go buy their own or try to figure that out. They definitely need to pay for a bookkeeper and a CPA because they got to do their own taxes. And most 1099 individuals, it very much is you get paid whatever it is that you work really, really hard to earn. Now, this is more often people that work in emergency medicine. I see a lot of 1099 individuals. I also see a lot of people that are surgeons with 1099. But there's a growing number of fields where there's a lot of 1099 income. So at this point, I think we're all thinking, Physician 2 has it made. All the other ones seem to make less and have more headache. Well, now we get to the net income. And this is just one example because it's really not just about what you earn. It's also about what it is that you keep. So let's talk about Physician 1 and 2. How much taxes can you realistically save? And let's not pretend like there aren't real numbers tied to this. There are real numbers. Let's look at real numbers here. First, there are your marginal tax rates. Whenever you are talking about saving taxes, you are talking about these marginal tax rates. And remember how earlier I said that all 4 of these physicians made the mistake of being single because the IRS doesn't like that? Well, this is where it's coming to fruition because of the fact that they are all single. They're going to have to go with tax rates based on single filers. And all of them make over 250, fortunately under 626 in this case. So they're going to be paying a lot at the 35% top marginal income tax bracket for at least half of their income. So from 250 to 500, that income is being taxed at 35%. So what can Physician 1 and 2 do? They're both W-2. Can't do anything really except put money into their retirement. Now, don't get me wrong, their employer will also put money, but that has no impact on how much taxes you can save. So in Physician 1 and 2's case, if they max out their 403b, 401k, whatever that is, there is a dollar amount. They can get back $8,225 by maxing out their retirement. That is the top level of how much taxes they can save. All right. So for those of you following along at home, You can, of course, say, well, I have a lot of other things I can do. I'm just saying from what you can do through your employer or through your employment opportunity, let's just say. All right. So, what will end up happening if you are W-2 plus 1099? Well, wow, that's pretty interesting. Okay, so first I'm going to max out my personal contribution. I can do that through my employer. So I'm going to get their match and all that good stuff. So that's 23,500. I'm pretty happy about that. But potentially I can also open up what is known as an SEP IRA or a solo 401k and potentially profit share in more of the employer portion. Now, I will say that between you and your employer, what will end up happening is you cannot go over the maximum contributions between you and your employer. And there is a set amount every year. So it is going to be a variable number, what that number is. But you will at least get, if you were, let's say in this hypothetical situation, your employer did not match, and you did both the employer and employee contributions, your maximum amount, in this case, using 2025 as the tax year, is $24,500 of taxes back to you, tax savings. Now, that's a lot of tax savings. That's a lot of zeros more. Well, one more zero. Uh, than what the colleagues in the W-2 camp can do. So that sounds pretty good. All right, let's talk physician 4 now. The person who's got all sorts of trouble. I mean, this person can't seem to catch a break. No benefits, has to make their own benefits. This person has to go out on a limb and do lots and lots of other stuff that physician 1, 2, and 3 don't technically need to do. Well, let's say that they do the same thing that physician 3 does. They make a 401k with a profit sharing and they put the maximum contribution in. Well, that's also $24,500 back in tax savings. All right. Now, they're going to go in and they're going to open, because they don't need the money at this point. They're going to go in and they're going to see if they qualify for a cash balance pension plan. And let's say that they do. Then what they can do is they're going to try to put as much as they can. And in this case, they have an actuary run the numbers and they say, hey, actually, you can put in a max of 179 this year. And every year this is recalculated. But in this example, it is that 179. Well, now they're getting $62,650 back minus the cost of the plans. So this is between all of these benefits added together that they're able to get that 62,000 of cash tax savings back in their pocket. And that's going to be more money for them because that's less in taxes that they had to pay. So, what does this tell us about net income? Well, oftentimes people will go in and they will have a certain opinion of how best to save on taxes. And a lot of the times, one of the things that you can or can't have control of is how you're able to structure your income and what roles you take throughout your career and what you do when you're in your roles and what is the maximum amount of tax savings that you have. But as you can see in this example, if you're efficient with how you structure how you save on taxes, it could significantly impact your ability to build wealth. Because for almost all of my clients who are in their earning career, I have found that their greatest expense, if you are a highly compensated medical professional, is taxes. And that is an ongoing burden. at least until retirement. And then it depends on how you've structured your assets. And it might still be taxes as your greatest possible expense. But that's another story for another day. I will say that net income is very hard to calculate. It is almost impossible to do without sophisticated financial planning software. However, if you are interested in this topic, happy to give resources to those who are interested in learning more about this at the end. And, we can certainly answer any questions that people have. But remember, your net income always needs to factor in taxes and the costs and benefits that you receive from your employer. So I hear this a lot too. I did blank to save on taxes. And I think that that's great, but oftentimes I find the tax tail is wagging the dog. Because what is the purpose of what you are doing? Is it to make money? Is it to save taxes? And how efficient are you at all of these things? Well, I think that there's actually an answer for this. And I'm just going to give you some common examples. I hear a lot of my clients say, well, I bought this home that's in this area of town that's just going to go to the moon. It's amazing. It's just this perfect property. I've researched the area. It's up. It's booming. That's great. Sometimes I'll hear people say, "Well, I bought this car, so I'm able to save money on taxes, especially for those people that have 1099 income." I'm just going to start right away by saying that if you want to make a total loss, just know that the government is happy for you to buy a car because it stimulates the economy, and the value of that car, you drive it off the lot, falls by half. It's going to take a long time to try to recuperate that. So actually, they're happy that you bought that car to lower your taxes. But let me just say that rental property seems to be the most popular thing that we hear. And I am very happy when my clients come to me with a real estate strategy. In fact, we try to help them do it better. But there are right and wrong reasons to engage in that strategy. And so today, we're going to use math and science to try to figure out if in this scenario that we're going to do, if it is right for this individual to buy a rental property. Of course, your personal experience and reasons may vary, but let me give you an example here. So using our existing physician 1-2, we are going to have to talk about the math behind whether it is right for physician 1 or physician 2 to buy a hypothetical rental property in order to save taxes. Now, I will say, person single, very big mistake in the eyes of the IRS. Horrible tax strategy there. But it looks as if you were to think about what this means for their taxes, that means that they only get to write, or their standard deduction is only $15,000. That doesn't make it anywhere of a dent on that $500,000 income. That's drop in the bucket. Once more, if they were married, it goes up to $30,000. The tax rates drop. It's amazing, but of course, not in this case. So 15,000. Keep that in the back of your mind. That's our null hypothesis. You do absolutely nothing at all. You can take the standard deduction, 15,000. Lowest possible reason. Okay, so physician 1 is now thinking, okay, well, I hear from my colleagues that I should buy a rental property in order to save on taxes. And I think that that's a great strategy. All right. Well, let's start with the initial math on this, right? Let's say that physician 1 buys this rental property January 1st, 2025. Okay, that's important because the maximum that you are able to deduct, it would be if you started at the very start of the year and you were paying your mortgage, because how mortgages work is you are paying mostly interest initially and just a little bit back to principal. And over time, as you pay down your loan, more and more will go to principal and less will go to interest. So, thinking about that maximum deduction, that's going to be $24,731 in the first year. So, if we were to think about it, that means that you are saving $9,000 more in taxes than if you just did the standard deduction. All right. But as we all know, there's a reason why you're getting to deduct this payment. And it's because it could be pretty significant. So looking at the mortgage calculator, in this case, this physician just wanted to test the waters, didn't want to go overboard, wanted to have plenty of ammunition to buy another home later on. This person is being conservative. They're putting 20% down on this property for a 425 home. They're making 500,000. Hey, it's affordable. But interest rates are 6.75-ish in this example, pretty close to what we're seeing approximately, although oftentimes rental properties are a little bit higher in interest. But in this case, the mortgage payment is $25.51, and that's assuming a property tax built in as well as homeowners insurance built in as well. So you have to keep putting money into this property now. So let's go into the second level of math. Let's say that there's mutual fund 1 and mutual fund 2, because oftentimes it's not just about the tax savings. It's going to revolve around the ability to expect that your asset is going to increase in value. So what's going to end up happening is you are going to put together a mutual fund that has a 6% commission to buy or to sell this mutual fund. There's a 2% expense ratio. There's a 9.7% though rate of return, annual average rate of return. So it's very likely that it is going to grow pretty fast. However, there's a 78% chance that you're going to need to put more in randomly at any given time. And it's going to be a significant amount. It could be 20,000, 30,000. And the annual expense ratio is 9.7%. So if you think about a lot of the times you read about, hey, you got to keep your expense ratios low. You buy low cost ETFs, buy low cost mutual funds, anything to get as close to 0% expense ratio as possible, you should do that. Versus mutual fund number 2, where there's 0 commission, there's almost no expense ratio, there's this expectation that you're going to get about 11% average rate of return, no chance of capital call, and it's unlikely that your expenses are going to go up every year. Which mutual fund would you choose? Well, it's kind of interesting because when we talk about buying rental properties, we don't think about it in terms of what exactly is its value as an investment. We instead think about it as doing multiple things all at the same time. And so we can't ever look at what it is doing individually in any given scenario. And we've already established that the maximum initial tax savings is just an additional $9,000 to your current taxes. And if you're married, it would give you no tax benefit because your standard deduction is still higher in this example. Now, we're going to evaluate it from an investment perspective, and it looks as if for mutual fund number one, it doesn't seem like a great deal because the ongoing costs of this mutual fund keep going up and up and up. And so I think if we were to think about the reason why, because people are rational, there's no reason why people would invest in mutual fund one unless there was a very compelling reason, because people are not foolish by nature. So the reason why is because in mutual fund strategy number one, there is a potential to do infinite leverage because technically many physicians can put 0% down and just pay off the home over time, which would in this case be mutual fund strategy number one. However, there is certainly going to be financing costs to this strategy. So I would say it's about 6.84% average financing costs at this point. And you would, in this example, of course, $20,000 initial investment plus the leverage costs of purchasing shares using the second mutual fund example, where you would slowly buy up more of that asset, let's say. But mutual fund strategy number one very much is you put 20% down in the first case, and you're slowly paying off that home, which is what you would call a systematic investment plan. As you're paying down that mortgage, you're continuing to pay the carrying costs of owning that home. So you're investing in this home. So in this case, I call it a mutual fund, just to make us think about it in investment terms. So you need to always think about this, like, what is my rate of return? What am I expecting to get? It cannot be based off of, well, I know that this area is booming. You need to always think, what is the total dollars that I'm going to put in my pocket after any of these strategies? So, what exactly is the result? If we were to try to calculate out what exactly you're going to get as a rate of return on these mutual funds, which you can use calculators on if you were essentially buying a home, what would you need and what is the likely rate of return? And I would say that there are times where there were a lot of highly compensated individuals that were very fortunate, and they bought homes back when interest rates were low. There were also individuals who are buying homes right now, and that has a significant impact on what you can expect for your rate of return. So if you were to have bought a home and you were to have stayed invested for 30 years, what would you expect your profit to be when you sell it? Well, and this is indeed a very big if, but if you manage to hold on to it for 30 years, your rate of return at 2% would have been 8.56. At 6% interest, it would be 7.59. But when you look and you see the cash on cash return of both, you'll see one's in the 4,000s, one's in the 3,000s. So small adjustments in interest rates will have an outsized impact on total return over time. So always keep in mind that when people are giving you the advice of, oh yeah, I bought a rental property and it's just done amazing for me, they're not always telling you exactly how much they were paying in interest during that time. So if you were to add all of this up, what I would say is that there is a very good reason for you to buy a rental property, and there are also reasons why you shouldn't. oftentimes I find that unless you're already doing a lot of other things that help you to leapfrog the standard deduction is so high that that cannot be your primary reason for buying this rental property. And instead, you should really think about it as what am I expecting for my rate of return on this investment? And usually you can math it out. You don't need to go in there and say, well, I think that this is a good investment because I'm able to save taxes and make a huge rate of return. All my colleagues say so. You can try to calculate this out. And there's a lot of tools out there that are both paid as well as free. In fact, in creating this presentation, I used a few free tools that are available online to calculate out all of these things. And this is not necessarily what I use with my clients whenever I am doing financial planning for them. But what I have found is that financial planning does help me add on more layers that cannot be shown here. So, in all of these examples, there's no way for me to say, well, this person is buying a home, but they're also doing this tax loss harvesting strategy, and they're also doing, and build on top of it. So if you're trying to figure it out, there are many tools that you can use to make rational decisions. It's just hard to pull it all together. But I will say that there are tools out there. They are available. If any of the things I've shown you today are of interest to you and you want those tools and all the things and resources that I used, you can always reach out to us at My Financial Coach. If you feel, hey, I'd actually like someone to do the math with me or for me, you can always scan this QR code and it will take you to My Financial Coach, and your questions can be answered by a certified financial planner who are one of our financial coaches. You might even have the misfortune of getting myself on the line, and I would be happy to see if My Financial Coach is a good fit for you. And also, if you wanted any resources that we can provide you. So that is going to be our presentation for today. I want to thank everyone for staying until the very end. I'd like to open it up to questions, and I I don't know if anyone would like to play question asker. I don't know, Dr. Khaled, if you'd like to do that, or I can always pull up the chat and I can read through the questions.
Yeah, please, Enpo, if you see any questions there, answer directly. If anyone has any questions, you put in the chat. You can unmute if you can, but by all means, feel free. We have a few minutes here to spare.
All right, excellent. And I'll be, of course, respectful of everyone's time. Uh, so, first question I see is, when is it appropriate to use a backdoor Roth strategy? Great question. So, it always amazes me how much effort is put into strategies that on paper make a huge long-term difference, but in the short term doesn't seem to make as much of a difference. But I can tell you that the backdoor Roth is definitely one of those strategies that I've seen a lot more interest in the recent past. Before, it was kind of a lesser known strategy, but now it's becoming more and more popular. Lots of articles about this. Let me tell you when it's not appropriate. If you already have an IRA that is taxable and open, and this could be a SEP IRA, it could be a simple IRA, or just a traditional IRA, you need to be very careful, because if you open up a taxable IRA and then you backdoor Roth, but you have a non-taxed IRA open at the same time, then the IRS is going to go, ho, 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 you seem to be very clever, but you're not actually doing a backdoor Roth. You're doing Roth conversions. So let's just use rough numbers, okay? Let's say that you have a $10,000 non-taxable, or a $10,000 taxable IRA open over here. You're trying to do a backdoor Roth on $1,000 over here, and you do it. Well, the IRS, if they ever audit you on this, they're going to say, well, actually, what you did was you did a $900 conversion into a Roth. So you owe us 900 on taxes here, and $100, that's okay. You did the backdoor Roth the right way on that 100. Now, I will say this. If you did want to do a backdoor Roth, you just have to be careful. Just make sure that all of your money is inside of employer plans such as 403bs, 401ks, whatever have you. But just do not do the backdoor Roth because you read an article. I'm sure that if you read through the whole article, look through, and you might find something about this, about, hey, be careful about the taxable IRA, or if there's any issues with this, but really you're just like, wow, this backdoor Roth seems really cool. I can't just contribute to a Roth because I make too much money. I can do this backdoor option. I would say just be very careful and mindful, because some people may not even know that they have taxable IRAs out there, because some smaller employers that you may have worked for may have actually kicked you out of their 401k and rolled it into an IRA. So just be very careful that you know exactly where your money is and how that works. Um, but otherwise, I will say that if you make too much money and you want a Roth, a backdoor Roth is great. It'll probably be more efficient than opening up a taxable brokerage and having that tax drag going on you. But as with all things, I would say it's just you got to think about the math on it, because there may be other things that you're also trying to do at the same time, such as, hey, I want to buy a home, or I don't really have I guess the cash flow for it, or hey, I got all these student loans. So it is a matter of trying to address your top priorities first. And that's much simpler when you categorize and catalog all of your assets and liabilities, so you can try to figure out, hey, what is the most impactful thing for me? Great question, though. All right. Let's see. Does Memorial Hermann 403B allow after tax non Roth contributions, followed by in plan Roth conversions to a Roth 403B and in service rollovers to a Roth IRA? Why or why not? Is there anything we can do so they allow it? Well, that's a really great HR fueled question. I'm not going to be able to answer many of these yet in terms of what MH allows, doesn't allow, but I will tell you this, right? Uh, when you are making any decisions on Roth versus traditional, it is good to know that most of your retirement dollars that you use to contribute, for the vast majority of cases, unless you plan to be making almost about the same amount of income when you're retired as you do when you're not retired, it might actually be helpful for you to say, hey, actually, I'm going to keep my income, um, basically my highest income earning years, I want to try to mitigate as much taxes as possible. And then as I get closer to retirement, usually my income falls off significantly, and so my tax brackets kind of fall down a little bit. Then I can explore Roth conversions. What I found often is that people don't really think through to the end, because unless you're creating a huge passive income portfolio that is going to keep goosing up your income forever, once you stop working, your income brackets should fall. And that's at least the theory. So it will be painful, but during the first years of retirement, the expectation is you should actually be trying to increase your taxable income by doing these Roth conversions a little earlier, so you won't have to deal with required minimum distributions later. It's essentially shifting when you do Roth contributions later on down the line. So I would say that as much as it is great to do Roth stuff, I would encourage you to do the math on it. And there's a lot of planning software out there that will definitely be able to illustrate that. I know that we illustrate that for almost all of our clients. And there's only a handful of scenarios that I've had clients that fundamentally should just do Roth because their tax brackets are going to remain the same all throughout their life. Uh, so I think the last oh wait, hold on. Let's see. Yeah. So the last question actually addressed at the very start. If anything that you found during this presentation was helpful, just know that you will be getting a copy of this presentation in its entirety sent over to you from my financial coach for anyone who's registered. We will also be providing it directly to Memorial Hermann, so that way they can distribute it in case our emails hit a spam filter and you're not able to receive it. Uh, in terms of this presentation, I just want everyone to know that I appreciate you for joining me on today's call. If anything seems confusing or if you wanted additional details into anything I presented today, please feel free to reach us at www.myfinancialcoach.com/Memorial Hermann, Memorial, I should say hyphen Hermann, and we'd be happy to connect with you and share more.